Out of the 30 holdings that I have in my portfolio, I naturally have some holdings that I like more than others. It's not that I'm big on speculatory positions or anything like that, it's just some companies I invest in have much larger moats than others. In this video, I'm going to talk about what investment I would pick from every high-yielding asset class if I could only hold one from each category. After that, I'll reveal what stock or fund I'd ultimately pick if I could only hold one dividend-paying investment in my entire portfolio. Note that any of these can change if I feel like a new ETF with a better strategy is introduced or if a better positioned company comes along in the future. So with that being said, let's get started. I'll start with covered call funds. This is, in my opinion, the most exciting category when it comes to high-yield investing because we're seeing new covered call ETFs being introduced all the time. Due to funds like JEPI growing massively over the past few years, a lot of companies have been jumping on the covered call bandwagon and introducing their own funds with their own unique strategies. Some focus more on dividend growth, while some focus more on share price appreciation. Some pay more during seasons of higher volatility, and some use synthetic covered calls while others don't. There's a lot of good CC funds that exist, but my favorite CC fund is still the NEOS S&P 500 High Income ETF, ticker SPYI. It uses a covered call strategy on the S&P 500, so it's well diversified, which is what I like. Its share price and dividends will climb as the market goes up, of course being capped like all of these funds. It pays monthly dividends and typically offers a yield between 11 and 12%. But there are a few additional features that sets this ETF apart from its competitors. SPYI's strategy allows for more upside capture in rising markets as well as more downside protection. It's actively managed, but it charges a lower expense ratio than a lot of their passively managed peers. It's entirely possible that someday a new covered call fund with a better strategy could come along and replace this as my favorite, but I've been a fan of SPYI for over a year at this point. When it comes to business development companies, there's a lot of really good companies in this sector. If you're a longtime viewer, you likely know what my favorite is, but it's honestly a tough decision. Barely coming in second place would have to be Main Street Capital. This company has an amazing track record of performance, and it's one of my best stock picks ever. It pays monthly dividends and has never gone through a dividend cut. The growth in dividends has been really outstanding over the years for this company, and it's just been an excellent performer overall. The reason why it comes in second, though, is because of its much lower yield. While most BDCs typically yield between 8 and 10%, Main typically yields between 4 and 6%. That's roughly half of what most stocks in this sector offer. But again, when looking at a total return perspective, it's been an outstanding pick. It's exploded in share price over the past year, and its recent earnings don't justify these significant gains in my opinion. So it's been a while since I've bought more shares of Main with the exception of reinvesting those dividends. But my favorite BDC is still Ares Capital, ticker ARCC. Ares Capital is the biggest company in the BDC space, and it has one of the most conservative payout ratios. They've sacrificed more aggressive growth to be a steadier position, which is something that I appreciate as one of my largest holdings. With equity REITs, most people already know what my favorite is. The monthly dividend company, aka Realty Income, is still my favorite. Although I have to say that Agree Realty Corporation is a really great runner-up. Realty Income, though, just has the better track record in terms of growth and consistency. They've grown their dividend for 109 consecutive quarters, and they're also a dividend aristocrat. Agree Realty doesn't have the same spotless track record that Realty has, but they have offered better growth for a while. Looking at mortgage REITs, this entire sector is getting destroyed like I mentioned earlier this week. I'm down to just one MREIT in my portfolio, and other than reinvesting the dividends, I haven't bought any additional shares for a while. My favorite in this sector would have to be Arbor Realty. For years now, this company has been the victim of countless short reports, and they've been struggling in our high interest rate environment, just like all MREITs. It's not yet known if ABR will be able to make it out of this without a dividend cut, like so many of their peers have gone through in the past couple years. Even if they do have to cut the dividend, I don't intend on selling this stock, because their management team has done such a great job in growing their business over the years. Compared to other MREITs, this company is just the best when it comes to growth. And I have no doubt that when the environment does get better, they'll be able to start growing again. Turning our attention to a different high-yielding sector, we'll briefly look at master limited partnerships. For investors that are willing to put up with the additional tax burden of investing in an MLP, these companies provide great exposure to the energy sector. My favorite stock in this category would be MPLX. Since merging with another energy company in 2015, which resulted in this share price decline, MPLX has been one of the best companies in this sector in terms of dividend growth. Not only does it yield around 8%, but its dividend increases are nearly unmatched by anything else out there offering a yield this high. They just announced their largest dividend increase ever back in October by an impressive 12.5%. There's plenty of other good MLPs out there, and I just think it's going to be a good environment for them in the years ahead. But MPLX was ultimately the first MLP I ever decided to invest in, and I have no regrets about it. When talking about closed-end funds, there's a few of these that I hold that I really like. There are so many different CEFs out there in terms of what they hold that my personal favorite might not be anything like what you're looking for. There are CEFs for high-yield bonds, convertible bonds, tech stocks, real estate-only funds, preferreds, infrastructure funds, utility funds, and on from there. This is also an investment type where I'm more tolerant of taking on more risk. My favorite closed-end fund provider is still PIMCO, despite what recently happened. I would have to say that PTY, the PIMCO Corporate and Income Opportunity Fund, is my favorite fund. I also do like PDI, which is the PIMCO Dynamic Income Fund, but PTY is safer in my opinion. It holds a wider array of investment types compared to PDI, which is much more concentrated in real estate. PDI hasn't had a dividend cut, unlike PTY, but PDI is a much newer fund. PTY's dividend has had a history of going up and down over the years. It's gone from paying 13 cents to 12 cents, then back up to 13 cents, and then back down to a little under 12 cents. Overall, it's just more balanced, which as you could probably figure at this point is something that I really like when it comes to my largest holdings. There's a few one-off investments that I have that don't fit into any of these categories, but what I just went through is one of every one of my favorite holdings in each major category. I should also mention that I'm not sponsored by any of these companies or fund providers to mention any of these investments. They're all holdings that I personally own and that I rely on for my dividend income. So after all these things considered, which of these holdings would I hold if I could only invest in one company or fund in my brokerage account? There's a few features that I'd want from the only holding in my portfolio. I'd prioritize a monthly payer if possible that can also offer growth when I'm not reinvesting my dividends. I'll also add that I'd want to hold this position regardless if it was in a retirement account or a taxable account. I would have to go with SPYI for this. To give a brief rundown of all the features this ETF has that I think really sets it apart is that it's exposed to 500 different stocks, making it well diversified. It also pays monthly dividends and yields close to 12%, which is pretty good in my opinion. It has better upside and less downside than other covered call funds. Its expense ratio is less than average for an ETF in this category, and it's also more tax-friendly, making it a better pick compared to other high-yielding funds for a taxable account. All these things considered, it's my personal favorite pick overall compared to the others. It likely wouldn't be for a lot of people though. I could see someone liking Main Street Capital more for its better dividend growth compared to SPYI, and I didn't even talk about a preferred ETF, which would offer a more sturdy dividend each month. Go ahead and let me know your thoughts. If you had to pick only one dividend-paying stock or fund, which would you choose? Leave a comment below. And with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.